idea about how the tax part of GST works. Let's up the ante a little further and get to understand four key ideas in GST. Four ideas that are central to the very functioning of the Goods and Services Tax Act. Idea number one is that of invoice. A short while from now, I'll try to tell you that we are going to graduate to one nation, one invoice. Idea number two is an idea called input tax credit. It is the presence of this input tax credit which is going to ensure that no product, no service escapes the tax dragnet, and it is this that is going to facilitate the seamless flow of taxes across the spectrum. The third key idea, an idea that is practiced internationally and an idea that has been fairly successful internationally, is called reverse charge. And ladies and gentlemen, the fourth and last idea that you must be conversant with is e-way bills. E-way bills have a significant role to play in GST, and I'll try to tell you what e-way bills are, and our experts will try to tell you how e-way bills are going to smoothen the flow of taxes. The government of India has stipulated a standard format for the invoice. It's going to be called the tax invoice. Every supplier of goods, every provider of service has to raise his invoice only in the specified tax invoice format, failing which the buyer of goods, the recipient of service, will not be able to take credit for the input tax that he paid. We would therefore rather seamlessly be able to move to the doctrine of one nation, one invoice. Let's look at a very exciting term called input tax credit. A manufacturer purchases raw materials, and on the purchases he pays VAT. He engages the services of a service provider to convert the raw material into a finished product. The various service providers charge service tax for the services rendered. Ultimately, on the production of the goods, he sells the goods and he has to pay excise duty at that point of time of manufacture, and he has to pay sales tax or GST at the time of sale. The taxes paid on the supplies as well as the taxes paid on the services, he could adjust it against the final tax he has to pay on the sale of the product. This is technically called the input tax credit. Under GST law, when you have to remit the money that you collected from your client, you can set off the money that you paid as GST and deposit only the balance with the government of India. Let me give you a numerical example for you to appreciate this point. The numbers that I'm going to talk about are only illustrative in nature. There may hardly be any relationship between the two numbers. Let us say there is a public accounting firm which invoice rupees 100 lakhs in a particular month. It would have therefore collected 100 lakhs plus 15 lakhs towards service tax, and in all would have raised an invoice for 115 lakhs. 100 lakhs towards professional fees, 15 lakhs towards goods and services tax. This 15 lakhs is to be deposited with the government of India. But hold on. In the running of its business, this public accounting firm has, say, taken a place on rent. And let's for a moment assume that the rent that it pays is 12 lakhs. Assuming that the service tax, the goods and service tax on rental is 15%, it would actually be forking out 1.8 lakhs by way of service tax and pays it to the landlord. Now, when it is required to deposit 15 lakhs to the government of India, it can net off the 1.8 lakhs that it paid to the landlord and remit only 13.2 lakhs. How does this 13.2 lakh get reconciled? 100 lakhs of income, 12 lakhs of expenditure, the value added therefore is 88 lakhs. 15% of 88 lakhs is 13.2 lakhs. And thus essentially what happens, thanks to input tax credit, is that the accounting firm pays GST on the value added. And that's precisely the reason as to why GST is a value-added tax. And internationally, most countries have embraced VAT. GST is payable on every good produced and every service rendered. There is a threshold limit at which GST kicks in. For all practical purposes, this threshold limit is 20 lakhs. So if my aggregate turnover does not exceed 20 lakhs, I do not have to register myself with GST and I don't become liable to collect and pay GST. For argument's sake, let us say I am a public accounting firm. I now provide a service to a manufacturer cum seller whose turnover is streets above that of the threshold limit and who is a registered GST dealer. Now if I raise an invoice on him for say rupees 2 lakhs, I do not have to collect 2 lakh into 15%, 30,000. But the dealer has on his own accord, has on his own violation, got to pay 30,000 to the government of India by way of GST. Of course, because that payment is made in the normal course of business, he will get input tax credit for that number, for that amount in the following month. You might wonder as to what is the big deal about setting up such a reverse tax mechanism when the reverse tax is going to ultimately get netted off. My sense is that there are two reasons. Reason number one, the government of India gets to know who are all the unregistered dealers. And if they find out that the unregistered dealer has an aggregate in excess of 20 lakhs, maybe they will move on to him. A second reason perhaps is the fact that while on a profit and loss basis, the registered dealer does not lose out anything because he pays his 30,000 this month, gets a tax credit of 30,000 in the next month. There is a working capital issue involved because it takes 30 days time for him to get his money back. Let's now move on to understanding what a waybill is and to understand how e-waybills will make a difference. A waybill is a physical document that allows goods to move from one place to another. In the current tax regime, we do have a waybill. But the way that it is prepared, the way that it is executed, makes the process very cumbersome. When GST kicks in, the movement of goods from one place to another will be governed not by a physical waybill, but by an electronic way bill, also called the e-way bill. For any transport of goods for value exceeding rupees 50,000, you will need a e-way bill. This bill is generated on the GST network and is available to the supplier, to the recipient of goods, and is also available to the transporter. When goods zip from one state to another, the e-way bill or the presence of an RFID on the truck will facilitate smooth flow of trucks without they having to wait at checkposts. For instance, a vehicle that travels from, say, Punjab up there in the north to Tamil Nadu down in the south will have to pass through 6 different states. In each of these states, it will go through a checkpost. It will have to log in and pay up the entry tax. And according to some estimates, a 24-hour travel is delayed by 6 hours on account of waiting at checkposts, which means that Indian business loses out 25% of time merely in the movement of goods from one place to another. The arrival of the electronic way bill is going to cut down this time to almost nothing.